Lending Club stock has crashed 22% after they announced their recent quarter earnings and they are currently trading at about $13. Is it a buy at $13? That's what I'm going to cover in this video. In full disclosure, I did a video about Lending Club about 2 years ago when it was trading at about $7 and I took a position of 400 shares at $7 each. So I sold about 100 shares when it hit $14 and I'm currently holding 300 shares at $7 each. Let's now look at the earnings that has caused the big crash. As you can see on the screen, the revenue target was achieved. It was $206 million expected, but they reported $217 million. But the EPS was a miss by about 15.62%. As a percentage, it looks really bad, but when you look into the numbers, the expected was $0.09 and the actual is $0.08. So that's not a big of a difference if you ask me. But this is still one reason why the stock has fallen. And when you look into the achieved financial targets, as you can see on the screen, for Q4 of 2024, the net interest income is 142.4 million and the non-interest income is $74.8 million. That's the B2B business, which is not doing very well, but they still could achieve 74.8 million. So that's actually good news. But look at the provision for credit losses. That's at 63.2 million. That's up from the previous quarter of $47.5 million. So that has freaked out the investors because they're anticipating something bad, that they're keeping 63 million on the side. So what is this PCL, provision for credit loss? PCL is an accounting expense that estimates the amount of money a company might lose from bad debt. It's a key metric for lenders to assess their financial health and risk management. So when Lending Club has increased their PCL value, it looks like they are anticipating something bad, that there will be more and more delinquencies. But when you actually look into their track record compared to their competition, their delinquencies are much lower, almost 40% lower than their competitors, because they write loans very well, right, compared to their competitors. But again, we do not know why they have kept a higher amount for PCL. They are anticipating something bad. But what I do know is that Lending Club has a very, very conservative management. So they would have put much higher amount than what actually is the case for PCL. But I like that they are actually conservative. And also look at their macroeconomic assumptions. They're only anticipating one rate cut of 25 basis points in the second half of the year. Initially, we were expecting 4 cuts. End of last year, we were expecting 2 cuts. Now, Lending Club is saying there's only 1 cut per their assumption. So if there are more than 1 cut, the stock will do good, but they're assuming the worst, which is good. Actually, being a bank that deals with personal loans, which are very, very, very risky loans, it's best to be very, very cautious than be sorry at a later point, right? So 2 points. One is the EPS miss. The second is a higher amount that's put aside for PCL. These 2 things have freaked out the investors and the stock has fallen down. Before I talk about whether this is a buy or not, let me show you the positives and negatives. The positives are 13% increase in loan originations to 1.85 billion, 17% growth in total revenue to $217.2 million, 24% growth in deposits to $9.1 billion, 34% increase in the pre-provision net revenue to $74.3 million, improvement in net charge-off ratio from 6.6% to 4.5%. These are the positives. Let's look at the negatives. Slight decrease in net income from 10.2 million to 9.7 million year over year. This is the EPS miss. Decline in return of equity from 3.3% to 2.9%. Higher provision for credit losses at 63.2 million versus 41.9 million prior year. 3.2 million non-cash impairment expense from Tally acquisition. So these are the negatives. Now let's look at whether this is a good entry point or not. For my case, in my opinion, when the market gets better, when the macro gets better, when the interest rates get cut down in future, I think they can achieve $2 billion of revenue, and 20% net margin will give them $400 million of net income. If I assume a multiple of 10, which banks get 10, they can be a $4 billion company by market cap. And when I divide the number of outstanding shares of 112 million, I will get a stock price close to $38. Currently they're at $13, right? So that's almost triple. But the problem is, this is a bank that deals with personal loans. It's a very, very, very risky investment. So that is still not enough for me. That 3x is also not enough for me because I'm taking very, very high risk. When it was at $7, I bought because I looked at a 5x there. But now we're only looking at a 3x. So for that high risk, we need like a 5x, right? But it may not get to $7. So what I could do is look at its book value. Banks trade on book values. The tangible book value is close to $12 now. So I would buy this stock when it's below its book value, just to be safe. So for that reason, I would be a buyer of this stock if it falls below $12, in which case it will be very close to the tangible book value. Otherwise, I'm going to stay out. Lending Club is not for everyone. It's a high risk, high reward stock. High risk means you can lose the entire investment. It can go to zero. If their delinquencies are high, this company can get wiped out. Even though this is a very, very high risk company, I invested in it because of the management. They are extremely cautious. For the past 10 quarters, they only focused on making a profit and survive in this highly challenging macroeconomic environment. They didn't want to be aggressive and try to chase growth to break something. They have been very, very cautious. They're trying to survive. That's why I bet on this company, even though it's high risk. Let me know your thoughts in the comments. Thank you so much for watching.